There is a 3-digit number attached to your name that decides what you pay for almost everything. Your car, your apartment, your mortgage. In some states, even your car insurance. Two people can walk into the same dealership on the same day, buy the exact same car, and drive away paying thousands of dollars apart. Not because one of them negotiated harder, because of this number. And almost nobody knows what actually moves it. So let's take the machine apart. Here's the first thing to understand, and it reframes everything that follows. Your credit score is not a report card. It is not grading how responsible you are. It doesn't know your salary. It has never seen your bank account. It doesn't know if you're rich, and it doesn't care. Your credit score is a prediction. One single prediction. It is a lender's best estimate of how likely you are to miss a payment in the next couple of years. That is the entire purpose of the number. Once you see it as a forecast instead of a grade, every strange thing the system does suddenly makes sense. But first, let's put a real price on it, because this is not a small difference. Take a $300,000 mortgage on a 30-year fixed loan. A borrower in the 620 range and a borrower above 760 are buying the exact same house, borrowing the exact same amount for the exact same length of time. The borrower with the lower score pays somewhere around $150 more every single month. Over the life of that loan, that's more than $50,000 in extra interest. $50,000. For the same house, that is the price of the number. So how is it actually built? Your score runs from 300 to 850. The most common version, the FICO score, is used by roughly 90% of top lenders, and it's built from 5 inputs. But those 5 inputs are not equal, and it isn't close. Payment history is 35%. Whether you pay on time, amounts owed is 30%. This is mostly credit utilization, meaning how much of your available credit you're using right now. Then the smaller pieces. Length of credit history, 15%. New credit, 10%. Credit mix, 10%. Now add the top two. 35 plus 30. Nearly 2/3 of your entire score comes from 2 questions. Do you pay on time, and how much of your available credit are you sitting on? Everything else combined is barely a third. Most people obsess over the small levers and completely ignore the 2 that actually move the number. Let's go into those 2, because the details are where the money is. Payment history first. The single most damaging thing you can do to your score is miss a payment. But here's what most people don't realize. Your account is not reported late the moment you miss the due date. In almost all cases, it isn't reported to the credit bureaus until you're 30 days past due. So if you forgot and you catch it a week later, you have almost certainly not damaged your score at all. You'll owe a late fee, but the bureaus never hear about it. Cross that 30-day line though, and it lands on your report, and it stays for about 7 years. Collections, 7 years. A Chapter 7 bankruptcy, up to 10. Now 7 years sounds like a death sentence, but it isn't. A negative mark's damage fades as it ages. A late payment from 5 years ago is doing far less to your score today than one from 5 months ago. The system is a forecast. Remember, it weights recent behavior heavily because recent behavior is what actually predicts the future. Now utilization, the 30% slice. If you have $10,000 in total credit limits and you're carrying $3,000, that's 30% utilization. The general guidance is to stay under 30%, but the people with the highest scores tend to sit under 10. And here's a detail that catches almost everyone. Utilization is measured both across all your cards and on each individual card. So you can have a beautiful overall number, 10% across 5 cards, and still take a hit because one of those cards is maxed out. The machine sees both. Now here is the single most useful thing in this entire video. Your credit card does not report to the bureaus what you pay by your due date. It reports your statement balance. The balance on the day your statement closes. So you can pay your card in full every single month, never pay $1 of interest in your life, and still show high utilization to the entire credit system. Because the number they saw was captured before your payment ever landed, paying on time protects 35% of your score. Paying before your statement closes is what controls the other 30. 2 completely different dates. Almost everyone only knows about one of them. Now let's use the prediction framing to explain the stuff that seems broken. Why does someone who has never borrowed $1 in their life, who has no debt at all, have no credit score? Not because they did something wrong, because the machine has nothing to forecast from. No history means no prediction. To a lender, they aren't virtuous. They're unknown, and unknown is a risk. Why does closing an old credit card you never use hurt you? Because closing it erases that card's limit from your total available credit, which instantly raises your utilization and it shortens your average account age. You didn't do anything irresponsible, you just made yourself harder to predict. And why can paying off a loan completely sometimes drop your score? Because you just closed an active account you were successfully paying. The live evidence stopped. Nothing bad happened. The forecast just lost a data source. None of these make sense if you think it's a report card. All of them make sense the second you accept it's a prediction. Let's kill 2 myths while we're here. First, checking your own credit score does not hurt it. That's a soft inquiry, and soft inquiries have zero effect. You can check it every day of your life. The only thing that touches your score is a hard inquiry, which happens when you actually apply for credit. And even then, a single hard inquiry usually costs fewer than 5 points, stops affecting your score after about 12 months, and drops off your report entirely after 2 years. Second, and this one saves real money. When you shop for a mortgage or an auto loan, you're supposed to compare lenders. Multiple lenders means multiple hard inquiries, but the scoring models know you're shopping for one loan, not 5. So inquiries of the same type inside a short window get bundled and counted as a single inquiry. Newer FICO models give you a 45-day window. Older ones give you 14, which means the safe move is to do all your rate shopping inside about 2 weeks. Important exception. This bundling applies to mortgages, auto loans, and student loans. It does not apply to credit cards. 5 credit card applications count as 5. So where do you actually stand? The national average score is around 714, which lands the typical American in the good range, but not the great one. Meanwhile, a record 48% of people now sit at 750 or higher. Look at what that means. The middle is thinning out, the top is getting bigger. If you're sitting at average right now, you are not in the group getting the best rates. You're in the group quietly paying more on every loan for years. One honest caveat before the action. There is no single credit score. There are many models and many versions. Lenders use different ones, and the exact weight of each category shifts depending on what's in your individual file. Treat these 5 categories as the shape of the machine, not a formula you can game down to the point. So here's what to actually do. 2 things. 1, put every bill you can on auto pay, not for convenience, because that protects the biggest slice of your score, and 1, missed payment does more damage than almost anything else you can control. 2, find the date your credit card statement closes. Not your due date, the closing date. It's on your statement, and it's in your banking app. Make your payment a few days before it. You will not spend a single dollar more than you already do. You just change the number the entire credit system sees. Same money, same habits, different prediction, and in the next video, we'll go after the mechanism sitting underneath all of this, because your credit score decides the rate you're offered. Interest is what that rate actually does to your money.